Well, we come off a couple of failed bond auctions, not only in the US but also in Japan, and we have this new spending bill that's going to be passed here in the US. It sure does look like it. I'm going to bring in Jim Welsh from Macro Tides to make sense of all this. Jim, how are you? Good to see you.
I'm good, Blake. Hope you're doing well.
Well, as we were saying just before we start filming, it's a little bit different. We've shifted our recording times a day early, so make sure everybody's you're looking for this recording instead of on a Saturday. You can find it on a Friday because we're recording on Thursdays, and we want to do that, because of the time and some of the things that are happening during these recordings. So want to make it a little bit easier on everybody to do this, but it's also as the markets open still, as they were on Friday. But we've had a lot of stuff happen this weekend, which is creating a lot of volatility. We've seen the markets have some jitters about, maybe some of the longer maturity debt, not only in the US, but in Japan too. So, Jim, why is the market so unnerved right now about some of this debt issuance that we're seeing?
Well, one simple word, supply. The idea being is that if you're not going to bring the deficit down and it's going to continue to be north of 6%, you're talking about a lot of supply. And if we ever go into a recession, that supply is going to be magnified significantly. And this is all counter to, remember, Treasury Secretary Bessent laid out, I thought, pretty forcefully that the debt trajectory of the US is at an unsustainable rate, and we need to get the deficit down from 6% to 3%. And as you and I have talked over the last probably 4 or 5 months, in light of Bessent's comment, my take has been, yeah, you're going to cut $1 trillion off the deficit. It's going to have economic repercussions. And I think what the budget shows that they're working on, and at least came out of the House with, is there are really no serious spending cuts taking place in the budget, so that the deficit will actually increase in 2026 and 2027. So I think, a little loss of confidence in terms of, gee, we thought we were going to see a serious approach to the budget, and fool, shame on us.
But Jim, okay, so the bond market's got jitters, but for stocks, it's good, right? You keep spending money, it's good. It's good for stocks.
Well, I think that's one of the reasons why the market has ignored, for the most part so far, the tick up in treasury yields. And as I've written in my weekly technical review, I thought that would be the case, that a little bit of an increase in treasury yields to some levels that we'll be talking about would probably be manageable. But breaking above some thresholds, I think that's when the stock market will start to pay serious attention. But you're right. The idea that they're going to spend more, keep the economy plugging along, and again, because Trump lowered or put the 90-day pause on the tariffs, people have concluded that, the problem with trade is going to work out. Inflation won't be so bad, and the economy is not going to go into a recession. So, it's a lot of things that are helping the stock market at this point.
So, well, one of the things that and I know you brought a chart to talk about this, or at least an image, was about Moody's. Moody's downgraded
Yeah,
U.S. debt right at the end of the day. It was like the equity market
Friday
was
no less.
closed. It was Friday. FX markets responded a little bit. We saw some dollar weakness
Yeah.
actually for the last 30 minutes before they closed trading in most brokerage accounts. So, what is it? Why did Moody's do what it did, and why is it perceived they're so late to the party?
Well, they're late to the party because the first downgrade S&P did in August of 2011. And that was also on a Friday, by the way. And the market got slammed on that following Monday and Tuesday. I mean, the S&P, I think, was down like 5 or 6%. And then in August of 2023, Fitch downgraded the US debt. So late to the party is in part because the other rating agencies had already taken the step that Moody's did. In addition, Blake, you could look at it in the sense that the last 2 years have been blowout years in terms of the budget deficit at a time when the economy is growing 2.5%. As I've noted repeatedly, that's never happened before. So I think from Moody's, they took a look at what the Republicans were working on. And I think that was like the final straw for them in the sense that we're not seeing a serious approach to reducing the deficit. And as a result, we're going to continue to see the outstanding debt continue to climb. So what this chart is showing is you can't see, but the revenue at the top, more importantly, is the part below the darker blue line, which shows how debt has increased from a very low level back in 1980 and progressively has accelerated lower. I mean, if this was a stock chart, we would start to use words like waterfall decline, because it's exponentially starting to fall,
Right.
which underscores what Besson had said, unsustainable path. Anybody looks at this and it's like, that old expression, catching a falling knife. Who wants to do that? In this case, we're talking 36 trillion of debt headed on its way to 40 trillion and so forth. So it also shows how different administrations, debt has continued to pile up. So both Republican and Democrats, as I like to say, the Republicans like to cut taxes and you wind up with a deficit, and the Democrats like to spend money and you wind up with a deficit. So both are responsible for causing this. But at some point in time, the grown-ups have to show up and say, you know what? This is truly unsustainable. Unfortunately, we're in such a polarized environment politically, Blake, that anybody who even broaches the subject of addressing the primary drivers of how the deficit is going to perform in the next 10 to 20 years, man, the other party is just going to take you to the cleaners and light you on fire and all the rest of that stuff. So unfortunately, I continue to believe that it's going to take a semblance of some kind of crisis where both Democrats and Republicans will start to act like grown-ups and responsible, supposedly leaders of this country and do something that really needs to be done. But
Either that, Jim, and I know these terms have been used very, very loosely. If we continue down this path, we are going to have a Liz Truss moment where
well,
where
yeah,
where
and
you're going to see the bond market sell off, yields are going to
yes.
rip, and the dollar is going to get crushed.
Correct. I mean, again, there's many reasons why. We've shown the chart of interest expense, which like 5 years ago was maybe $350 billion a year. Now it's over a trillion. We're spending more on that than on defense. And, another 4 or 5 years with the way we're going, interest is going to consume an ever larger portion of the annual spending budget. So, again, I think we are, people like to throw the word existential around, right? Well, for us, I think this is an existential crisis. You don't have to be a rocket scientist to say, I don't know when it's coming, but the question of if it's coming should be answered by now. It is. So this goes back a 50-year chart of federal spending as a percent of GDP and the revenue as a percent of GDP. And we've had a structural deficit for most of the last 50 years because spending as a percent of GDP has averaged about 21% and revenue has averaged 17.3. So, a structural deficit of about 3.5%, which gradually, in that prior chart, you can see gradually the amount of debt increased. Then obviously the financial crisis, spending shot up to, I think, about 24+%. In COVID, it exceeded 28%, maybe up to 30%. But you can see since COVID, the trajectory on spending continues to be creeping higher as a percent of GDP, while tax revenue is really stable. Last year, tax revenue came in at 17 17.1% versus, or 2% versus the 50-year average of 17.2. The problem is spending. But for me, again, I'm not going to toss around the word existential and say, okay, well, the whole problem is spending. It is part of the problem. But if I'm facing the kind of challenge that we are, I would be amenable to raising taxes. In other words, I try to narrow the deficit, two-thirds of it by cutting spending, and one-third figuring out ways to increase some taxes to bring this gap down to less than 3% and ideally closer to 2. That's what's needed. But the political will in both parties is almost non-existent.
Right. So this is where, you start to have a crisis in the bond market because
Yes.
you're pointing out we have a 30-year treasury bond secular bear market. Tell us what this chart represents.
I started showing this chart with you, I think probably a year ago. And basically what this shows is from, interest rates in this country peaked in 1981. The 30-year was up around, I think, close. The 10-year got over 15%. And the 30-year was close to that, right? And then we had this magnificent, almost 39-year rally up until 2020 when the 10-year got down to about 50 basis points. And I think the 30-year was just about 1%. So what you can see is this is an incredibly well-defined trend line because look at all the different touch points over that 39-year period. And we decisively broke through it.
I know
The other
people that
thing
made
from
their
that
whole
high in
career on
19,
this chart.
I'm sorry.
I know, and I'm sure you know people that have made their whole career on this chart back
Oh
before it
yeah.
broke. I
Been
mean,
buying every dip in the bond market for 39 years and you were a hero. Okay.
that's right.
The other thing that I'll point out is from that high in March of 2020, you can see one down, a little wave two bounce, wave three, another bounce, and then wave four into October of 2023. So in October 23, I turned bullish bonds because, hey, after a five-wave down, we're going to get a rally. And I thought we would see bonds rally enough that TLT would make a run at 100. It went from 82 and change to 100 very quickly. I mean, it was like about a 2-month rally. But my point is the bigger, longer term message here is the bond market has structurally broken down. And maybe now we're starting to see why. And supply is a big part of the equation
Yeah.
because at some point in time, unless demand rises commensurately with supply, rates are going higher. And so to me, that's the longer term message that rates are going higher. And it, in a sense, is confirming what we already know. Both political parties uh, are a joke when it comes to being fiscally responsible.
I
And
remember I
unfortunately,
remember being a Republican in the 90s. I was always like, yeah, I'm conservative. I'm a little liberal with my socially
social,
liberal, but fiscally conservative. There's no such thing as that.
no. I mean, again, going back to Bill, I've grown to have more respect for Bill Clinton than I did 20, 30 years ago because he did a balanced budget and they actually had a small surplus. They did reinventing government. They shaved about 420,000 federal jobs over a period of, I don't know, 6, 7 years. And he tacked to the middle and worked with a Republican Congress, and they actually got things done. Work requirement for welfare. Well, right now, any idea of working for government handout, the Democrats are going nuts now because that's what's happening with Medicaid. Blake, is the Republicans are saying, you know what? If you're able-bodied between 18 and 54 or some window of age like that, and you're capable of working, if you want Medicaid, you're going to have to work X number of hours a month. I think most people say, well, that doesn't seem that unreasonable. Oh, by the way, we're not going to allow people who are in this country illegally. And the estimate is north of 1 million people are getting Medicaid. So the point being is even the slightest change is being demonized at this point in time by the Democratic Party. Oh my God, you're going to rip, healthcare, hospitals are going to close, the sky is going to fall. And unfortunately, Blake, we've dumbed down the populace in this country. You can graduate from college with a degree and know virtually nothing about finances and the economy, and to understand what's going on with the budget, percent of GDP. Hey man, that stuff goes over people's head. But do they respond gutturally to, hey, they're going to steal this from you, they're going to take this away from you? Yeah, people respond to that stuff. So this is the problem, unfortunately, is you got a lot of factors coming together. And this is a big time challenge. And I don't think we're going to be capable of answering the bell unless there's a crisis. And I
Well,
think we'll see that happen.
yeah, you wanted to talk a little bit about this budget proposal before we get
Yep.
into some of these charts. So,
Yeah.
what are we looking at here?
Well, basically, if you look at it, according to Moody's, uh, the deficit will increase by 480 billion in 2026, 590 billion in 2027. Oh, gee, what that's right before an election. What a surprise in 2028. And then they get serious in terms of, bringing the deficit down. And some of that stuff is gimmicky too, where, no tax on tips and overtime. I think eliminating maybe some of the taxes on Social Security. All that stuff is expensed only through 2028. So here's a 10-year budget, uh, but yet we've got some goodies in there that are going to expire in 2028. And so if those things are extended, it would increase the deficit by another 1.5 trillion or so before 2034. The
Yeah.
one thing I will
Oh,
say,
okay.
like, is the 2017 tax cut is ending at the end of this year. If that isn't extended, taxes are going to go up by 3.5 trillion, call it. So part of the numbers that are being bandied about are, in a sense, saying, well, the tax cut's going away, but now we're going to reinstate it. So that's going to increase the deficit by 3.5 trillion. So there's some fudging numbers here in terms of understanding conceptually. There isn't a tax cut in this bill. There's an extension of an existing tax cut. So, bottom line though, this budget, from my point of view, is not a serious attempt to address the budget deficit, both from
Okay.
a spending standpoint as well as a tax standpoint.
Well, and then the other issue, Jim, it's probably with your next chart here. We're not going to get the revenues that we thought we were going to get with tariffs because, I mean, let's face it. The Trump administration probably faced a lot of heartache from
Yeah,
constituents, lawmakers, from the public backlash, seeing stocks upended and backed away, and so we're not going to get that makeup here, right?
right, right. So, if you do the math, imports last year represented 14% of GDP. And I'm trying to think of, GDP is around 31 trillion, I think. So, 13% of it is 520 billion. And then what's 13% of 520 billion? In terms of the revenue, theoretically, it could propose, and you're talking,
30
uh,
billion. It's, I don't know.
no, it'd be more than that, but the 300 billion or so. But
Okay.
to your point, it was being bandied about that it was, oh my God, going to be this big savior, and it isn't. And again, at the beginning of this year, the tariffs were 2%. The effective tariff rate in the US was 2%. And now it's 13%. And both companies are going to have to eat some of that, and so are consumers. Walmart, in the last week, came out and said, an increase this large, we're going to have to pass along to consumers. And
Now
of
they
course,
got they got
President,
they got backlash from President Trump.
yeah, I mean, again, anybody who states the obvious, which is, tariffs are going to be paid, at least to some extent, by consumers, because companies aren't going to eat all of them. And the exporting country isn't going to eat all of them, and so they had the timidity to, yeah, We can't eat all those. You know what the average profit margin for every dollar of sales Walmart had?
Uh,
It's less than 3%. Okay. So if they want to stay alive and you got a huge increase in tariffs and your cost of business, you've got to pass them along. So my point is that because President Trump rolled this stuff back for 90 days, I think a lot of people, oh, thank God, the worst of inflation isn't going to be a problem. The impact on the economy isn't going to be a problem. And it's like, okay, let's get a little sober about all this. From 2% to 13%, that's a huge increase. And if it's, yeah, it's not going to generate the kind of revenue that they were bandying about. But if it's $300 billion or 200, that's coming out of somebody's pockets. And it also means, Blake, that profit margins for a lot of companies are going to shrink a little bit, which is not obviously great for the stock market. So companies that are more export, that import goods, they're going to
yeah.
be more affected than domestic producers. But 2 weeks ago, the president of the Cleveland Fed said she was getting reports that companies that don't import stuff have been raising prices because they know their competitors who do rely on imports will have to raise prices, and using that as their cover, they're raising prices. So there's some knock-on effects to this that happens. It isn't just, like you're in a silo. The only thing we're going to get price increases is from the stuff that's coming in that's tariffed. No,
Yeah.
there's some bleed through when other companies are competing against those people and they're going to raise prices. So my point being is the inflationary impact is still going to be somewhat meaningful. It's not going to be as horrendous as it would have been a few weeks ago before we cut tariffs. But I think, he basically cut them in half. So from 26 down to 13, but you're up from 2%. So I think there's a lot of things that people are overlooking and will continue to overlook until we start to see the ramifications show up in things like some of the inflation reports that we're going to get over the next few months.
Sorry, Jim, I don't see anything, nor do I hear anything. And so, all
You
right. The next chart you brought here is the 30-year versus the 10-year, and you like to point out these divergences, but this is a pretty significant. I was having a conversation yesterday with Chris Weston, who's the head of research at Pepperstone in Australia, and he was mentioning term premium. I mean, this is why,
Yep.
for this longer dated these longer dated securities, you got these 30-year yields that are ripping where the 10-year is not, because you're like, hey, look, if I'm gonna buy a 30-year piece of paper from you, you better be paying me on it. If not,
Yeah.
yields got to go up, right? I mean, is
Right.
that what we're
Right.
seeing here?
Yeah. Well, his mention about the term premium increasing is spot on, and that's contributing to this divergence in terms of how much more the 30 years going up.
Sure.
So in thinking about this, this morning the 30-year got up to 515. Lo and behold, that was the high back in October of 2023. Comparatively, the 10-year was at 499, and this morning it got to what, 463 or something. So, we're seeing that play out significantly. So, I thought the 30-year getting above 5% was important. And yesterday the market kind of reacted to that. And the 10-year getting above 459. So I think there's a chance, Blake, that we'll see the 30-year take out this 515 and the 10-year will run up to tag that blue trend line, which is around 476, 477, something like that. And that's going to be the ultimate test. Because if the 30-year breaks out and the 10-year doesn't get above that downtrend line, then we're going to probably see treasury yields come in a bit.
Okay.
But if we see the 30-year breakout and the 10-year breakout above that trend line and then break out above the most recent high at 489, I think the market's going to get crushed.
Well,
But
Jim, I want to ask you, are you willing to step in front of that train right now?
no,
Okay.
no, no, because look at the momentum. The momentum is pretty powerful. And I think the narrative being what it is, Blake, there's buyers on the sidelines that are like, you know what? Let's see how this plays out. So I'm not the only one who wants to step in front of a freight train, which is kind of what's been going on here. You mentioned early on about a failed auction in Japan, where their 10 and 20-year and 30-year yields are moving up rather aggressively. Next week, I'm going to show a chart that, I talk about the secular bear market in the US. Guess what? The same thing applies to Japan and some other countries. So this global breakout in yields is, I think, part of the story of the idea that we're seeing a secular bear market sweep across bond markets around the world.
All right. So, and make
So
sure if you guys and gals like what you're seeing here, make sure you give Jim a big thumbs up, and make sure you're subscribed to the channel so you get to see next week's charts that he's going to bring, showing this global bond market breakdown with yields ripping balls. I can't wait to see it. Can't wait to see it. All right. So, what does that mean for the S&P here? Because the S&P really now, I'm gonna just I have to do this, Jim, just because I've been
yeah,
harping about it on a long time. I have a big ascending wedge that looks like this
yes,
or like that, and we're
yeah,
actually
yeah,
starting to break down. But how are you seeing this? Because it's not quite the way I'm looking at it. I don't
yeah,
think,
yeah, yeah.
but let's
Well,
see.
back in February, as the stock market was topping, I showed the advanced decline line. I wrote about it extensively in terms of the S&P was making higher highs, the AD line wasn't. To me, it was telling us that the market was vulnerable to a correction, and if a good reason materialized, it would be greater than 10%, which of course we did with the tariff news. All right. Well, the AD line last week made a new all-time high. So to me, I'm giving, I know what you're talking about, that wedge leads to a bearish decline. And I'm not dismissing that. We're in kind of funky territory right now in a lot of these markets. I just think there's the potential that we'll see a pullback and then another move up, that may or may not get us to new highs. But I think that's the way I think is the higher probability. And then we'll see if that plays out that way, then I think we'll see a bigger correction. So, right now I think we've got a dip coming, and that's what last week I said I think we're near a high, a dip towards 5,600, and so far the weakness that we're seeing I think is in line with that. But you start taking 5,600 out, then that starts to become a little bit more problematic. And if you take that high out of 5,481, to me, that would be even more problematic because if one's bullish, that has to be the top of wave one.
Yeah.
And so one, two, three, and four is not supposed to overlap one. And so to me, that's the drop deadline in terms of looking for additional upside in the market.
So Jim, I was taking a good look at, and I know you were around during this period of time, just before the dot-com bubble like blew up. It was the year 2000, and I was trading through those markets, and I noticed a lot of parallels between this current structure where we're at right now in the S&P versus where we are at in the S&P back in the 2000s. You should take a look at that. We call it a fractal. It's very similar price action. Obviously, the sell-off after the Liberation Day it created way more volatility than we got back then. But it's interesting, Jim, where even though you're like, okay, this is wave 3, 4, 5 might break highs or close to. Remember, our all-time highs is up here around like whatever it is,
6147.
6147. So
So my assumption here, Blake, is that we won't take it out on the next push, and then you get a pullback. And if that pullback is three waves, then that implies that the next rally will take that out definitively, and not by just 50 S&P points, by a lot more. So, for me, I'm just looking at it. It's like a baseball batter. You
yeah.
got to hit the pitch that is thrown to you. And, a low and outside curveball is not a good pitch to swing at. And so to me, watching the markets here is waiting to see where's the pitch thrown and whether or not it's in the strike zone. And, the jury's out, at this point in time. I was saying the advanced decline line is supportive of additional upside. The other thing I'll mention is I'm starting to write the May macro tides, and the shift in sentiment regarding the economy is and the markets have been extraordinary. At the April lows, people were extremely bearish. People were looking for the economy, various like the betting polls, Poly Market, and there's the other one, Kalshi, okay?
Yeah.
They were at like 66, 67% probability of a recession starting in 2025 as the market was making its low. Guess what? They flipped almost entirely. And now, 65, 66, 70% don't think we're going to have a recession.
Hmm.
It's extraordinary that we've seen this shift. And I just think we're in this window of time where you need a reason to sell to drive the market lower. And I think we're in this little window of time where that there may not really be a reason to sell other than treasury yields breaking out. So if I'm right and the 10-year gets up to that blue trend line we talked about, the 30-year takes out 515, that would provide a window of selling pressure.
Yeah.
And then it's a question of do yields reverse and start to come off? That's how we can get more upside in the market. If the yields keep running, I think the market would really be under a lot of pressure.
I agree. Well, the question would be what happens with gold because you've been looking for a significant high to be reached. We are stalling, but I don't want to say we're selling off yet. How do you feel about gold here?
Well, as I noted last week, you got three waves down from that 34.96 high, which implied that we were going to get a bounce probably off that trend line as well. We got the bounce. My take is that decline from 34.96 to 31.27 was the first part of a larger correction. The bounce to 33.43, the high yesterday, is the midpoint, and that potentially the initial decline was $291. You subtract that from 33.43, and you got a target of 3,051. So I think there's more downside coming in gold.
Okay. All right. All right. Fair enough. And so I would be watching that trend line like a hawk, I guess, if I was you people at home, not me people, you people. All right, let's go into what it means for the dollar because you, I think, had thought there was a pretty good chance we've created a major low in the dollar for now. Is that correct?
Yes. Yeah. And I
Okay.
still am of that opinion that from a longer term standpoint, the dollar either made that low at 97.92. Getting above that blue downtrend line to me was constructive. And then, of course, we rolled over and head south. So there's the potential that the dollar will drop back down below 97.92 to finish the decline that actually began in October of 2022 when the dollar traded up to 114.78. So we're talking about a correction that's been in progress for 2.5 years. I think we're near the end of it. Sentiment is still very bearish, the dollar. Positioning is bearish, the dollar. And it's almost like this weakness now, Blake, is causing that bearishness to manifest even more. So, I think for all those reasons and the chart pattern, I think one has to look to be a buyer of the dollar index on weakness, especially if it gets below 97.92. I think that's going to be a great entry for the long side because my bet would be is the dollar will rally at least enough to retrace about half of the decline from 114.78 to below 97, or pardon me, 98. Maybe even lower if it drops to below 97 or something if we do go down a little bit more. So just from a longer perspective, I think one has to be looking at the dollar as more likely to rally. And again, people forget, 57% of the dollar index is Europe. And, I think Europe's got some very deep-seated problems in terms of regulatory, economic growth. And yeah, they're going to spend more on defense. Is that going to help? Yeah. But they got other bigger fish to fry. They still have their high cost of energy as a problem. So I think there's the potential that the euro made an important high or is in the process of doing that if the dollar does drop down one more time.
Okay. Well, it's fair enough. I can't say that I look at the euro and I look at the US and every other country. I'm like, which one is the least dirty? So I think we have to figure that one out. Well, Jim,
Yeah.
I appreciate your time every week, and I know traders do as well. Remember, if you have any comments for Jim, jump down in the comments below. Also, it's free to give him a thumbs up. It's free to subscribe to this channel so you don't miss this exclusive content that you're going to find on Friday mornings. Jim, I know it's Memorial Day weekend, so I hope you and your family have a nice holiday as you celebrate the summer season.
Yep. Thank you so much. Same to you, Blake. And, we're just going to do more of the same in the next few weeks. I mean, we're in this kind of twilight zone of economic data and political news, and so forth. So again, thanks for tuning in, folks.
Yes, and enjoy your long weekend. Tip your hat and drink a beer for all the ones that we've lost that have protected our freedom. So happy Memorial Day for those of you that celebrate, and for those of you that are enjoying the UK bank holiday that's over there, enjoy that. I'll catch you next week with Jim right here on Trader Summit. Thanks, Jim.
Have a good one.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.